The dollar then reversed, and since then we've been heading higher in a series of longs. We held that 130 figure, had the 148.50 targets. We went to target. We held the next measured move, and now find ourselves consolidating between highs and that measured moves entry. I mean, we're consolidating. We haven't reversed this range. It's basically a 50 to a $1.40 range, and I think I guess it's a 1,000 pip range that we are currently bouncing around in. I don't see any catalyst for breaking this range, until the ECB potentially does hike rates, which, then you have a carry trade factor that should support the euro dollar, or the stock market really does crash, which I just don't foresee happening, and we'll get to that in one moment. But the current trend is alive, and we're holding, a very technical market here. I mean, we haven't broken any trend lines, and we still hover above this scary trend line, which is kind of drawn against all the highs. We're holding it as support still. So I do kind of favor, even inside of this trend on a daily time frame. Let's move down to a 4-hour chart so we can take a look at this more closely. I do favor continued upside. In this series of measured moves from that 128, the 130 lows, that took us to 148.50 targets. We headed there. The first level that traded, again, was that extension from this little tiny high at $1.30 just after the lows to this high at $1.3860. We held the 50% and traded to targets. We blew through targets, and inside of that series we began a new series of moves that took us up to our target, our original targets. We then held same anchor, new high for that extension. We held to the pip, the 50% entry, and I see this as a second test of that entry. We failed the halfway back short. We failed the halfway back long inside of these ranges. Both provided free trades, and now that we failed both, I think we're going into a wedge. That's usually what happens when you fail one. You bounce between support and resistance until the range breaks. So now we can look for, so we had a short failure, broke the 61.8. We had a long failure, broke the 61.8, and no new lows. Now we look for the short. We're going to look for a 61.8 or 50% hold or failure that could take us out of this trend, but there's, I don't like to say there's any halfway back in this range until we can confirm a resistance or support by invalidating this trend, and this trend would be invalidated with a 137. So technically speaking, I know it's a long way down, but we could be heading higher as long as we're above this 137.30. It's the way it is. It doesn't mean that we don't break down, or we couldn't break down hard from here, because that certainly have the potential to do so, but as it stands, probability favors that we go into some kind of wedge and then break that range. And when we break that range, then you can buy or sell on a break of the range, or trade the wedge, trade the range. So there is the possibility, and there always is the possibility, that this first move down, because you can count this move as impulsive, that we had some kind of A, B, C, where this is a 1 down and this is your wave 2. If that's the case, there's no reason that says that isn't it, but this kind of rally, it does look like it's short covering, but because we're closing the week on highs, and we could go up until we don't here. From this high, though, we were making a series of measured moves. So high to lows, we held a 50%. We traded down to 61.8 targets. Entry to lows, we failed. We technically failed this setup. We haven't broken and closed above the 61.8, so technically speaking, a 139.70 target might still be in play from right here. But odds favor, if we are going to find resistance, we would do it from the 147 highs to lows at around the 143.80 figure, 143.90. So between 143.80 and 144, I see as the potential for the next sell area, and that would have a 139 target. But like I said, we do have that's a high risk trade, because you do have the possibility that we are just range bound in this kind of wedge forming, and we will be for the remainder of the summer. Okay, and now for the S&P 500. The daily chart, you're looking at a chart of the continuous contract E-mini S&P futures. We've gone over this several times before, but we've been trading in extensions ever since the 666 lows. Traded once to target, traded twice, same anchor new low to target. Very similar to the dollar. The correlation is there. To target, same anchor, new high. Is all the way down at 1066 with a 990 line in the sand. A 990 goes, and we are in a bear market and potentially targeting new lows below 666. Now, in the series of measured moves that took us up to this target at the 1330s, inside of that measured move, and we should probably move down to a, I do want to point out, this whole move up, we continue with bearish divergence, and every single high has held that trend and respected that trend very well. Alright, so that does, with every new high that you get more divergence, you are fulfilling the the odds that you could see some kind of reversal. Alright, that's not going to, unfortunately that chart isn't going to do us very good because we're outside of a figure. Alright, so move the oscillator for now. And we just want to look at this last leg up, basically from last July. So the last year, the last 52 weeks, what we've been doing in the S&P 500. We failed to hold a halfway back long. We did, however, continue higher. We blew through whatever targets this dirty pull. We blew through targets, and we traded extensions. So from the 1130 highs here, I believe it was 1127.75 high was exactly it. So let's try to, that's close enough. We held an extension from highs to highs, held a 50% retracement, blew through targets, traded once to target, same anchor new high, twice, might have front run the target, but same anchor new high gives us a major level here at the 1250. We've held it. We traded it. It was front run by 2 pips or 2 points. Good enough for a daily, I think, to be front run by 2 points. We also have failed to close below the 200-day moving average. The 200-day moving average is one of the most, in my opinion, one of the best swing indicators for daily swing trades on the S&P 500. You can see the way down. When we roll over and broke below it, we failed to break back above it for the entire bear market in 2008 and even into 2009. Then when we broke above it, back above it, we failed to close back below it before we rallied higher. We danced and flirted with it through that consolidation period after the May flash crash, but once we got back above it and held there, it's been up ever since. And we are in longs still. Like we are in short trend on a smaller time frame, but I'm sorry, we're actually holding extensions going down, but we are not that far off from breaking that short trend. So, we if the dollar does catch a bid, we have a number, we have a number of areas of support that could still come into play for the S&P 500. Namely, the first is is right here at the 1250 level. We break below the 1250 level and evaluate at 1221. The only support there really is from the 1000 lows to highs. Been over this level before. But from lows to highs, next support after this 1250 level, and we invalidate the 1221 obviously, is like at 1190. That gets invalidated at the 1144, and there's no new support until about the 1000 level at the 988s. So this market is technically in measured move longs, and will remain so. And obviously after the 988s, if we ever do go there, there is kind of weak support, I'd say, at the halfway back at about 1000. So between really the